Welcome back to the deep dive. Today we're dissecting a crime scene, or well, financial crime scene anyway.
That feels like the right way to put it.
The victim, or maybe the culprit, it's hard to tell, is Badger Meter, ticker symbol BMI, and the date is January 28, 2026.
It was certainly a bloody day on the charts.
Bloody is, putting it mildly. The stock dropped nearly 15% in a single trading session.
Yeah.
Now, usually when a boring, steady Eddie industrial company sheds that much value in just a few hours, you assume something truly catastrophic happened.
Right. The CFO absconded with the cash, the factory burned down, something fundamental broke.
Exactly. A massive product recall. But here is the paradox, and this is what we really need to unpack today, because frankly, it just doesn't make any sense on the surface.
It's a real head-scratcher.
On the exact same morning, the stock absolutely tanked. The company reported record profits.
Record profit.
Record earnings per share. Record free cash flow. And they raised their dividend for the 33rd year in a row.
It's the ultimate disconnect, isn't it? The numbers on the page scream success, but the market's reaction screams failure.
So are we looking at just a massive market overreaction? Or is there something rotten underneath the floorboards that the algorithms picked up on and we missed? Because usually, when the street sells off a winner like that, they know something.
They do know something, but I'd argue in this case they're reacting to a timing mismatch, what the company's management is actually calling an air pocket.
An air pocket.
Yeah, rather than, a structural rot in the business. This isn't really a story about a broken company. It's a story about valuation, about project pacing, and about a massive transition in how we as a society actually measure water. But to understand why the stock collapsed, you first have to understand what Badger Meter is trying to become.
Right.
Because they are not just casting brass parts anymore.
Yeah, I think most people, if they even know the name Badger Meter at all, they picture the guy in the blue jumpsuit coming to the house to read the meter on the side of your house.
It feels
1950s.
And that's the exact image they are so desperately trying to shed. If you read the Q4 2025 earnings call transcript, and you look at these analyst reports we have, the company is basically screaming from the rooftops that they are a water technology company.
Water technology?
Right.
It sounds a little bit like marketing fluff, doesn't it? Everyone wants to be a tech company because tech companies get, 30 times earnings multiples, and manufacturers get 10. Is it real, or is it just branding?
I think it's real, but it's a very specific kind of tech. They're what's known as a pure play on water.
A pure play.
They've sold off everything else over the years, no gas meters, no electric, just water. And the shift is from selling hardware to selling intelligence.
Okay.
Think about it this way. For 100 years, their business model was selling a mechanical device that sat in a dark basement for 20 years.
Right.
And once they sold it, they basically didn't talk to that customer again until it broke.
The old fire and forget model.
Exactly. Now, look at this blue edge ecosystem they keep pitching. They don't just want to sell you the meter anymore. They want to sell the cellular radio attached to it. They want to sell the sensors that are monitoring pressure and quality in the pipes that lead to the house. And most importantly, they want to sell the software, the sauce, that brings all of that data together.
So they're trying to become the Microsoft Office of water utilities.
That is the exact analogy used in the source material. And you know what? It really holds up. If you're a utility director, you might think you just need a meter today. That's your Excel spreadsheet.
Right.
But once you're inside the Badger ecosystem, it becomes incredibly easy for them to sell you Teams and PowerPoint, which in this world is leak detection analytics or water quality monitoring.
Okay, let's look at the revenue split then, because I want to see if the money actually backs that story up. The sources break down the business into two main parts, utility water and flow instrumentation.
Right. The flow instrumentation side, that's the industrial bucket. It's roughly 12 to 15% of sales. It's important they're selling meters to HVAC systems, chemical plants, wastewater treatment facilities. It's a steady business.
But it's not the main engine.
It's not the engine. The engine is utility water.
Yeah.
That's 85 to 88% of the revenue. This is their franchise business. It's selling to the 50,000 plus water utilities across the United States. And you should note the geography there, 90% of their sales are domestic.
So this is really a bet on American infrastructure.
It is, through and through.
Okay, so this Blue Edge strategy is targeting those American utilities. How much of that is actually software at this point? Because if they're claiming to be a tech company, I expect to see some real recurring revenue.
And we are definitely seeing it. In Q4 of 2025, their SaaS revenue grew 27%.
27%.
That's a serious growth rate for an industrial firm. And it's not a fluke. Over the last 5 years, it has compounded at about 28% annually.
But what's the base? I mean, is that 27% of a tiny, tiny number?
It is still relatively small in the grand scheme of things. It's about 8 or 9% of their total sales right now.
Yeah.
But, and this is the crucial part, you have to look at the margin profile.
Okay.
Hardware margins, selling the physical meter, are usually in the 35 to 40% range.
Which is good. Solid for manufacturing.
Good, but standard. Now, the software,
What are we looking at?
the SaaS gross margins are around 80%.
80.
80, right. So every single dollar of software revenue contributes twice as much profit as a dollar of hardware revenue. This is why the valuation has crept up so much over the years. Investors absolutely love that mix shift. It makes the earnings more durable and way less capital intensive.
Okay, so that explains the long-term bull case.
Oh.
It makes perfect sense. They're converting a hardware business into a software business.
Yeah.
But that still doesn't explain the 15% drop on January 28th.
Mm-hmm.
If the strategy is so great and it's working, why did the market panic?
Because the strategy hit a speed bump. Or, to use the CEO's term, an air pocket. Let's look at the specific numbers from Q4 2025. Revenue came in at $221 million.
And what was the expectation?
The street was looking for something closer to $232 million. So they missed the top line by about $11 million.
Ooh.
And in a market that's priced for perfection, our revenue miss is, well, it's a mortal sin.
Especially when you're trading it. What was the multiple before this?
Before the drop, it was about 43 times free cash flow.
Ouch. Yeah, 43 times you do not get to miss your revenue number. But here's where I get confused again. You said they had record profits. How do you sell $11 million less stuff than expected but make more profit than expected? Usually when your sales dip, your fixed costs just eat you alive and your margins crash.
And that is the paradox of profit you mentioned right at the top. The answer lies in something called revenue quality.
Revenue quality. Okay, that sounds like something a CFO makes up to hide a bad quarter. Oh, well, we didn't sell much, but it was high-quality revenue.
And in many, many cases, I would totally agree with you. It sounds like an excuse. But here, the math actually supports them. To understand this, we have to talk about something called turnkey projects.
Okay, define that for me.
A turnkey project is when Badger Meter acts as the prime contractor for a whole installation. A city comes to them and says, look, we don't just want to buy your meters. We want you to manage the entire installation, dig the holes, hire the crews and the vests, and handle everything from start to finish.
And Badger agrees to do that.
Historically, yes. But here's the catch. Badger doesn't have a construction division. They're a manufacturer, so they have to hire local subcontractors to do all the digging and the plumbing.
So let me get this straight. Badger bills the city, say, $1 million.
Right.
And then immediately turns around and pays the subcontractor $900,000 of it.
Exactly. It's pass-through revenue. It looks great on the top line. It makes the company look bigger and like it's growing faster, but it absolutely crushes the margins. It's empty calories.
Ah, okay. I think I see where you're going with this.
In the second half of 2025, a bunch of these large, multi-year turnkey projects just came to a natural end. The installation phase was finished. So suddenly, that huge chunk of low-margin, pass-through revenue fell off the books.
Which caused the $11 million miss on the revenue line.
That's the miss. But the revenue that remained
Was the good stuff, the hardware and the software, the things they actually make in their own factories.
the high-margin stuff.
Yeah.
Exactly. So while their total revenue went down against expectations, the mix of that revenue became incredibly rich.
And that's why their gross margins jumped up.
They didn't just jump, they surged. Gross margin hit 42.1%. That's an expansion of 180 basis points year over year. For an industrial company, moving your margins by almost 2 full percentage points in a single year is it's massive.
So the argument from management is essentially, we shrank, but we got fitter.
Precisely. They shed the fat, which was the low-margin installation revenue, and they kept all the muscle, the high-margin tech sales, and that's what drove that record EPS number of $1.14.
Okay, I buy that. It makes logical sense. It's actually a good story. But clearly, the market either didn't buy it or they just didn't care.
Yeah.
Because they still hammered the stock down 15%. If the business is getting fitter, Why the huge sell-off?
Because the market is a forward-looking machine, right? It doesn't really care about the quarter you just reported. It cares about the next 6 months. And Badger Meter's guidance for the first half of 2026 was, well, let's just call it sobering.
This is the air pocket.
This is the air pocket.
Yeah.
Management explicitly warned of an inverse effect.
And what does that mean?
Well, usually Badger has a strong first half of the year.
Right.
In 2025, for example, they had a monster H1. But because those big turnkey projects have ended and the next wave of big contracts hasn't started shipping yet, they are looking at a very, very slow start to 2026.
How slow are we talking?
Organic growth in Q4 slowed all the way down to 2%. They're guiding for a flat to slightly up first half of 2026.
And there it is. That's the smoking gun. You cannot trade at 43 times free cash flow with 2% growth.
You absolutely cannot. The multiple compression was instantaneous. The market looked at that 2% growth number, completely ignored the margin expansion story, and said, this is no longer a hyper-growth stock. And the valuation reset from 43 times down to roughly 26 times FCF in a matter of hours.
It almost feels like a punishment for being transparent. If the CEO had just, taken on some garbage, low-margin contracts to puff up the revenue numbers, the stock might have actually held up better in the short term.
Perhaps. But Kenneth Bockhorst, he's the CEO. He seems really determined to play the long game. He's clearly prioritizing cash flow and profitability over just revenue vanity. And speaking of the long game, we have to talk about why the growth has slowed. It's not just about contract timing. There's a fundamental technological transition happening that's causing some of this friction.
You're talking about the move from mechanical to ultrasonic meters.
Correct. This is really the heart of the whole Blue Edge story.
I want to dig into this because a critique we sometimes get is that we can gloss over the actual tech. So let's get into the physics of it. What is the actual tangible difference between the old meters and the new ones? Why is the entire industry switching over?
Okay, so the old standard, the one that's probably in most of our listeners' basements right now, is the nutating disk meter. It's a type of positive displacement meter.
Nutating disk.
Yeah.
It sounds like a part from a science fiction movie.
It does. But imagine a small, sealed chamber inside the meter with a flat disk inside of it. There's a ball in the middle. As water flows through that chamber, it's forced to go around the disk, which makes the disk wobble or nutate. Every single wobble corresponds to a very specific volume of water that's passed through.
Yeah.
That wobble turns a gear, and that gear turns the dial on the meter.
So it's basically a little mechanical engine, and it's driven by water pressure.
Exactly. And just like any mechanical engine, it has a fatal flaw.
Friction.
Friction, it wears out. Water isn't pure, right? It has grit, it has sand, minerals. Over 10, 15, 20 years, that grit acts like sandpaper on the disk and inside the chamber. The clearances, the tiny gaps, they open up.
And water starts to slip past the disk without making it wobble.
Precisely. So the meter slows down.
It under-registers the flow.
It under-registers. And this is the crucial part. It doesn't under-register linearly. It gets particularly bad at very low flows. So if you have a toilet flapper that's leaking at, say, 0.1 gallons per minute, an old mechanical meter might not even spin at all. The static friction is too high for that tiny flow to overcome.
So the customer is getting that water for free.
Correct. And for the utility, that is non-revenue water, they paid to treat it, they paid to pump it, they delivered it to the home, and they got paid zero for it.
And then enter ultrasonic.
Enter the E-Series ultrasonic meter. 0 moving parts. It's basically just a straight tube. It uses 2 transducers, one upstream, one downstream, and they shoot sound waves through the water.
That's a little sonar device.
It's a very similar principle. It's called time of flight. If the water is flowing, the sound wave that's traveling downstream moves just a little bit faster than the one that's traveling upstream against the current.
Okay.
The meter measures the nanosecond difference in time between when those 2 signals arrive and uses that to calculate the precise flow rate.
And since there's no disk, there's no friction.
No friction, no wear and tear. Sand and grit just pass right through it. The accuracy curve is basically flat for 20 years, but the real game changer is the low flow sensitivity. These things can accurately read down to 0.05 gallons per minute.
0.05.
It catches the drip. It catches the tiny silent leaks. There was a case study in the source material from Summit Mutual Water Company. They installed these new meters and they suddenly found all this water revenue they didn't even know they had. They started calling them parasitic leaks.
So for a utility, buying an ultrasonic meter is kind of like giving themselves a raise. It pays for itself just by catching the leaks that the old meter was completely missing.
That is the sales pitch in a nutshell.
Okay.
And it is working, but, and this is important, creating these high-tech meters exposes Badger to a different set of risks. And this connects right back to the bear case for 2026.
Risks. I would thought solid state was safer. Less to break.
Operationally, yes. But economically, you have to think about input costs. The new CFO, Daniel Weltzian, he specifically flagged an issue with rising prices for bialloy and copper.
Hang on, I thought you just said the new meters were plastic.
Right. The housings of the ultrasonic meters are often an engineered polymer. So yes, high-tech plastic. But Badger still sells a lot of the old mechanical meters. They haven't discontinued the old product line. There's a huge installed base that still buys them for replacements. And those mechanical meters are made of brass.
And brass is copper and zinc.
And in this case, bismuth.
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 Like the pink stuff in stomach medicine.
The very same. Years ago, the entire industry had to get the lead out of brass, for obvious health reasons. They found that replacing lead with bismuth made the alloy machinable. It's called bialloy.
I see.
Well, the price of both bismuth and copper is forecasted to rise in 2026. And since Badger still has a pretty significant manufacturing footprint making these old metal meters, those rising input costs are going to eat into their margins in the first half of the year.
So it's a double whammy for this air pocket. Sales are slow because of the project timing, and the margins on their legacy products are getting squeezed by commodity inflation at the same time.
That's exactly right. And that's why the guidance was so cautious. They're sort of stuck in the middle of this big transition. They want to sell everyone the new plastic ultrasonic meters, which have very stable costs.
But they still have to service the old metal mechanical market, which has rising costs.
Exactly. It's a tricky spot.
It really feels like they are walking a tightrope. If they fall off in the first half of 2026, the stock could go lower than 15% down.
That is absolutely the risk. But, and this is the big but that all the bulls are hanging their hats on, there is a safety net, a massive safety net, that's scheduled to appear in the second half of the year.
We're talking about Puerto Rico.
We were talking about PRASA, the Puerto Rico Aqueduct and Sewer Authority.
I saw the phrase 8 Orlandos in the earnings call transcript. That definitely caught my attention.
The scale is just staggering. PRASA has roughly 1.6 million service connections. The management team compared it to the size of 8 City of Orlandos combined. It's an entire island-wide utility.
And Badger won the contract to modernize their entire grid, the whole thing.
They did. But let's go back to our earlier lesson on revenue quality. Remember how those turnkey projects with all the installation labor just killed their margins?
Right. The pass-through revenue.
The per se deal is a supply-only contract.
Oh, that is the Goldilocks scenario, isn't it?
It really, really is. Badger is not flying crews down to San Juan to dig holes. They aren't dealing with local labor shortages in Puerto Rico or permitting delays. All they are doing is cranking up the machines in their factory in Racine, Wisconsin, manufacturing 1.6 million meters and radios, putting them in boxes and shipping them south.
So it's just pure high-margin factory utilization.
It is the most efficient kind of revenue a manufacturer can possibly have. It absorbs overhead, it runs the machines at their optimal speed, and it comes with zero installation risk. It's beautiful.
So when does this start? Because if I'm an investor who just lost 15%, I need this to start tomorrow.
It doesn't start tomorrow, and that's the rub. Deployment begins in the second half of 2026. This is the primary reason for that inverse year they talked about. The first half is the second half is the big ramp up.
And how long does a deployment of the size last?
It's a 5-year deployment schedule. So this isn't a 1-quarter bump. This provides a baseline of high-margin, predictable volume all the way through 2030.
That really changes the perspective on stock drop. If you believe the PRASA deal is solid, and it sounds like it's a signed contract, then this air pocket is really just a waiting room.
That is the bull case in a nutshell. The argument is that the market just offered you a 15% discount on a company that has a guaranteed 5-year revenue stream that's set to begin in 6 months.
But is it really guaranteed? I mean, Puerto Rico has had, let's just say, some infrastructure challenges in the past. Hurricanes, grid failures. Is there a risk that the deal falls through or gets delayed?
There is always execution risk, of course. But PRASA has secured the funding for this. This is part of a federally backed infrastructure modernization effort, and frankly, they need this more than almost anyone.
Why is that?
Because island utilities tend to have the highest cost of water and energy. Pumping water takes a huge amount of electricity. If you are losing 40 or 50% of your water to leaks, which is not uncommon in aging island infrastructure, you are literally burning expensive diesel fuel just to pump clean, treated water straight into the ground.
So the ROI, the return on investment for Puerto Rico, is just massive.
It's existential for them. They have to fix the leaks. And the Badger ultrasonic meter with its cellular radio is the perfect tool to do it.
And speaking of tools, Badger isn't just relying on this one mega contract to save them. They've been using that debt-free balance sheet to go shopping.
Zero debt, which is a real rarity these days for an industrial company.
It really is. And it gives them firepower. I want to talk about this acquisition, SmartCover. This takes us beyond the meter. Most of what we've discussed so far is clean water coming into the house. SmartCover is the duty side of the equation.
It's the wastewater, the sewer system.
Why does a water meter company want to be in the sewer business?
Because the utility runs both systems. And the headaches on the sewer side are arguably much, much worse.
How so?
Well, if a clean water pipe leaks, you lose some money and you might have a puddle. If a sewer pipe gets blocked and overflows, you have a haze-net situation on your hands.
Right.
You've got raw sewage in the streets or backing up into people's basements. You have the EPA coming down on you with fines of tens of thousands of dollars per day.
Nobody wants that phone call.
Nobody. SmartCover is a brilliant little acquisition they made. It's a remote sensor that mounts on the underside of a manhole cover. It looks down into the darkness of the sewer pipe using radar or ultrasonic tech, similar to the meters, and it just monitors the level of the flow.
So it can tell if the level is rising when it shouldn't be.
Exactly. If a grease blockage starts forming downstream, the water level behind it starts to rise. The SmartCover device wakes up, pings a satellite or a cell tower, and sends an alarm to the city's public works department. High level detected at manhole 402.
So they can send a truck out to jet the line and clear the blockage before it spills?
Correct. It completely changes the utility's posture from being reactive to proactive. And this is the core philosophy of the new Badger meter we're talking about.
There was a quote in the source material I wanted to bring up, something about a canary.
Yes. A utility operator said the days of using the canary are going away.
And he didn't mean a literal bird, I assume.
No, he meant the customer. For a century, the canary in the coal mine for a water utility was an angry customer calling to say, my basement is flooded with sewage, or why is my water bill $500?
Which is a terrible detection system. By the time the customer calls, the damage is already done.
It's already done. Badger's entire Blue Edge strategy, the smart meters, the pressure sensors from their Syrinix acquisition, the water quality sensors from their ATI acquisition, and now the SmartCover sewer monitors. It's all about building a central nervous system for the water grid. They want the utility to know about the problem long before the customer ever does.
And are utilities actually paying for this? I mean, it sounds expensive to deploy sensors everywhere.
SmartCover generated $40 million in sales in 2025, and it was growing at 25%. Utilities are quickly realizing that paying for the technology is much, much cheaper than paying for the cleanup, the lawsuits, and the massive EPA fines.
It's basically an insurance policy.
It is, and it's a recurring revenue insurance policy.
So let's zoom out here and try to put a bow on this. We have the air pocket in the first half of 2026, a clear headwind. We have the massive PRASA deal saving the day in the second half. And we have this long-term secular shift to SaaS and high-tech sensors. But I want to play devil's advocate one last time.
Go for it.
What if the air pocket isn't an air pocket? What if it's a ceiling? The housing market is cooling down. New housing starts are a big driver of new meter sales. If builders stop building subdivisions, doesn't Badger meter just stop growing?
That's a valid concern, and new construction is definitely a driver for them. But you have to remember, about 70 to 80% of their business is replacement.
Replacing old, worn-out meters in existing houses.
Right. There is a massive installed base of mechanical meters out there that are reaching the end of their 20-year useful life. And on top of that, you have regulatory pressure like the EPA's new lead and copper rule that is forcing cities to dig up old pipes and modernize their infrastructure regardless of what interest rates or the housing market are doing.
So the base demand is somewhat inelastic. Cities can't just decide not to measure water this year.
They can delay a project by a quarter or two, which is exactly what we're seeing in H1 2026 with this air pocket, but they cannot cancel it forever. The meters are dying. They have to be replaced. And when they do replace them, they aren't going to put another dumb mechanical gear back in the ground. They are going to upgrade to the smart ultrasonic technology.
Because they want that sauce revenue stream. They want to be able to catch the leaks.
The tide is only moving in one direction here. The Q4 revenue miss was like a wave pulling back from the shore, but the tide itself is still rising.
So final verdict,
Yeah.
you're the judge. We have a company that just lost 15% of its market value in a day. Is this a falling knife that we should all avoid, or is this a buy-the-dip opportunity?
I think the analyst consensus quote of risk-defined, portfolio protected is probably pretty accurate here. This looks like a tactical entry point for a long-term holder.
Explain what you mean by tactical entry point.
It means the bad news is out, it's all on the table. The revenue miss is known, the weak guidance for the first half of the year is known, the stock has already repriced from a frankly euphoric 43 times multiple down to a much more rational 26 times. Unless you believe the Prasa deal is going to get canceled, which seems incredibly unlikely, the downside from here seems fairly limited. You're essentially buying a very high-quality industrial compounder at a discount because other investors don't have the patience to wait 6 months for the growth story to reaccelerate.
Patience pays, as they say.
In this case, I really believe it does.
You know, as we wrap this up, I keep coming back to a thought I had while I was reading through their Blue Edge manifesto. We tend to treat water like any other utility. Gas, electric, broadband. But it's fundamentally different from all of them.
How so?
We can always generate more electricity. You can build more solar farms, more wind turbines, more nuclear plants. We can drill for more natural gas. But we cannot generate more water. The amount of water on planet Earth is fixed.
And the amount of usable fresh water is effectively shrinking every day due to contamination and aquifer depletion.
Exactly. Water is the only utility where the core product is becoming scarcer every single day. And as the cost of water inevitably rises, and it will, the cost of measuring it accurately becomes almost irrelevant compared to the cost of losing it to a leak.
That's a profound point. If water is cheap, a $100 meter seems expensive. If water is liquid gold, that $100 meter is the most important asset you own.
Badgermeter isn't just selling hardware anymore. They are selling the only tool civilization really has to manage its most finite, most essential resource. And that sounds like a business model that will probably survive a 6-month air pocket.
I certainly wouldn't bet against them in the long run.
That's it for this week's deep dive into Badgermeter. A reminder that this conversation was generated based on source materials from January of 2026. As always, do your own diligence, watch out for those air pockets, and we'll see you next time.
Stay curious.